We are back to discussing the components of what's known as a multiple step income statement. We will now focus on the non operating activities section of the multiple step income statement. So, as I mentioned before, these are activities that came from a source other than our principal type of business activity. So, under the other revenues, we have interest revenue, we have again disposable plan asset. Upon the other expenses, we have interest expense, and then we had a loss that came from vandalism. So again, these are not our normal type of operation activities, and they're shown separately on the classified income statement. Now we'll take the income from operations, add the other revenues and gains, subtract out the other expenses and losses to determine the amount of income before income taxes. Now, for each problem for homework or on the quiz or for the test, I'll either give you an income tax rate or I'll give you an income tax amount. So if you're given an income tax rate, you take the rate times the income before income tax amount in order to determine your income tax expense. Subtract the expense from income before income taxes to determine the amount of net income. So as you all can see, the multiple step income statement is a lot more detailed and it provides more information about that business organization. Okay? There's another statement which is not as familiar, but it is required now. It is called the comprehensive income statement. The comprehensive income statement. Now, there are certain type of items that are not included in the calculation of net income on the traditional income statement. There are some different type of gains or losses that are not reported on the income statement, but they are part of what's known as your comprehensive income statement. So to not go into much detail right now, we have a chapter to go in more detail about it, but there's some we call unrealized holding gains and losses. Basically, when we have investments and those investments values are changing, they're going up, they're going down. We haven't sold the investments, we still have them, but the values are constantly changing. We're saying, well, how do we account for the change in those investments? We do have to report those, but they're reported on a separate statement known as the comprehensive income statement. So if you have any type of stock that you've purchased and you know that you have those stocks, but you haven't sold them just yet, but the value keeps fluctuating, we look at the value of those investments at the end of the accounting period. And depending upon whether they have increased or decreased, we may have an unrealized holding gain, meaning the value has gone up, or an unrealized holding loss, meaning the value has actually decreased. So you're going to add the gain to your net income to give us known as comprehensive income. If it's a loss, subtract that from net income to calculate your comprehensive income. Okay? So we're going to take a few minutes to take a look at how to prepare a multiple step income statement. So you ready? You excited? I'm excited. Let's go. So notice that they gave us information for a certain account, sales revenue, operating expenses, yada, yada, yada. They gave us the tax rate as being 25%. We want to take all of this information and prepare a multiple step income statement for the Art Center Corporation. All right? So think about what is your starting point in preparing a multiple step income statement. You want to first calculate your net sales. So how is that calculated? Net sales would be sales revenue less any sales return allowances. and less any sales discount. So for our example, we have sales revenue and we also have our sales discount. So to do that calculation, we'll take our sales revenue less our sales discount. That'll give us net sales for $442,000. All right. Notice what you have next would be your gross profit. So I have a question for you. How do we go from net sales to gross profit? What's in between these sections? If you said cost of goods sold, that's correct. You're going to subtract your cost of goods sold from your net sales to get your gross profit. In this situation, a gross profit amount of $295,000. Now, once you have your gross profit amount, we're saying, how do we go from gross profit to income from operations? I give you a second to think about it. Drinking my water. Water's good for you. Okay. If you said operating expenses, once again, you're going to be correct. You're going to subtract the operating expenses from your gross profit to calculate your income from operations. So it's a 295 minus the 187. That'll give us income from operations of $108,000. All right. Next, we look at our other revenues and gains. We have for $8,000. Other expenses and losses for $3,000. Now, notice we're going to net these two amounts together. Depending upon which is greater, in this case, the other revenue and gains is higher than the expenses and losses. So that $5,000 is added to the income from operations to give us income before income taxes of $113,000. Now recall that the income tax rate was 25%, I believe it's 25%. So you're going to take your income before income taxes, get my calculator just to be sure, 113,000 times 0.25, yep, it was 25%, to get your income tax expense for $28,250. Subtract that from income before income taxes, and voila, we have our net income in the amount of $84,750. You get that right? Okay, good job. Now for the comprehensive income portion, we had other comprehensive income, but it is shown net of taxes. So the other comprehensive income was $10,000, but then we show it net of taxes, which is $2,500. So the $7,500 is shown, and that would give us comprehensive income in the amount of $92,250. So there you have a practice example of preparing the classified income statement as well as the comprehensive income statement. Now, I mentioned before there's two different types of inventory systems, the perpetual and the periodic. The perpetual is our main focus because it is used by most corporations, but I do want to touch upon the periodic as well. With the periodic inventory system, we do not calculate cost of goods sold until the end of the period. We look at our beginning inventory. We'll then add the cost of goods purchased, what you purchased during the current accounting period. We'll add those two together. Then subtract out the ending inventory to calculate your cost of goods sold. Okay? So for example, if our beginning inventory was $36,000, then during the accounting period, we had a purchase of $325,000, but then we had returns of $10,400 and a discount of $6,800. You're going to subtract any returns and allowances and discounts from your purchases to calculate your net purchases. Again, subtract any returns, allowances, and discounts from purchases to get your net purchases. Then add in your freight costs, that's your shipping costs, to your net purchases to get your cost of good purchases, in this case for $320,000. Add that to your cost of goods sold to get cost of goods available of $356,000. Subtract out what you have remaining in the inventory to get your cost of goods sold in the amount of $316,000. So this is how you calculate your cost of goods sold under the periodic inventory system. Okay, almost done. A few different ratios: a gross profit rate and a profit margin. The gross profit rate shows what we call the markup on the actual sales price. Difference between what we sold a product for compared to how much we pay for the actual product. So the gross profit rate has a formula. The formula is here. It is your gross profit divided by your net sales. Again, gross profit divided by your net sales. So you take your gross profit amount and divide that by net sales to get your gross profit rate. So for REI, for example, they have a markup of 43.3% on the cost of their products. Compared to Dick's Sporting Goods, they have a gross profit rate of about 31.3%, and for the industry at large, their rate is about 34%. So what does that mean? It means that REI has a higher markup on their products than does their competitor, Dick's Sporting Goods. Okay, so probably you would get a better price by going to Dick's Sporting Goods than REI, but REI has a higher profit margin because they're selling their products for a higher price. Okay, then we have last what's known as the profit margin rate. With the profit margin rate, we're going to look at your net income, let me show it to you, divided by your net sales. Net income divided by your net sales. So for REI, they have a profit margin of 2% in 2014, which was an increase from 2013 0.9% compared to 5.4% to Dick's Sporting Goods and 5.1% for the industry at large. So although they had a higher gross profit rate, they have a lower overall profit margin. So what's that telling us? It's saying that for REI, they have higher operating expenses than does Dick's Sporting Goods, because overall, their overall profit margin is only 2% of their sales amount compared to 5.4% for Dick's Sporting Goods. So that tells me that in between gross profit, right, and income from operations, you have your operating expenses. So REI has higher operating expenses than Dick's Sporting Goods, causing them to have a lower profit margin. Okay, so we use this type of information from an accounting standpoint as an analyst to try to figure out how can we reduce those operating expenses in order to increase our profit margin. Okay, well, that will conclude our lecture over Chapter 5, Merchandise and Operation, and the multiple step income statement. I hope you have enjoyed this information, and we'll say so long for now.